Okie dokie. Okie dokie, everyone. Can I start off by saying either a very good morning or a good afternoon or even a good evening, depending, of course, on where you are around the world. Can I also say a big thank you to everybody who's taken the time out to join me tonight on tonight's little webinar, and I appreciate it. My name is James Alexander. I'm the market analyst here at Banc. And today is one of the episodes of a new series. Hi, Abby. Nice to meet you. It's a new series I've put together called the Discover Trading Series. Okay. And tonight's episode is called Discover a Mind of a Trader. Okay. Like I said, written by myself, James Alexander, who's the market analyst here at Banc. Now, the reason why I've picked this topic particularly tonight is because I tend to feel that when people are beginning to understand or learn or educate themselves about trading, they sometimes get themselves a little lost and look and focus more on, say, technical analysis, things like this, trying to look for the Holy Grail. And I tend to think, though that is indeed an important factor in trading, what really matters is your mindset and your approach and your character to try and make it in this wide trading arena. Now, do a little introduction on who I am and yours truly. Now, this sultry black and white image is myself. Like I say, I'm James Alexander. I'm the market analyst here at Banc. I have over 20 years experience in the financial service industry. I actually started out at the ripe old age of 18, and I started off actually doing mortgages as a mortgage broker actually in the UK. As you can probably tell by my accent, I am indeed a Brit, so please don't hold that against me. So I started off as a mortgage broker in the UK. I specialized in buy-to-let and commercial mortgages. I then went into pensions and alternative investments before entering the online trading arena around about 12 to 13 years ago. And I have indeed, like I say, traded myself. I traded gold options actually, and both gold physical actually, through the Dubai Gold and Commodity Exchange, and ran several floors around the world. And, I've also then gone into portfolio management before I went down the educational route and sort of share my experiences and my knowledge. Now, one thing I will say, okay, though I have got a good rounded experience in the financial service industry and obviously in trading, and I'm extremely passionate about it, I never, ever call myself an expert because I don't believe there is a such thing as an expert in this field. What I try and do instead, this is my approach, is I try and share with you a few things and some ideas with the idea that you can take that on board, improve your own knowledge, your own education, and find your own path in this industry. I'm a published writer. I've actually been published in several leading industry publications, the likes of Financial Times Advisor, quoted in the Market Watch, which is the Wall Street Journal, and obviously The Street and several other magazines and papers. And I'm very often writing articles and opinion pieces on what I see is happening in the market. As well as that, I am an avid market commentator. And like I say, I'm very passionate about these markets, very passionate indeed, and I hope to share some of that passion with you. Now, okay, before I carry on, can everybody hear me okay? Everybody can hear me all right, yes? The sound's okay. Can everybody hear me okay? Well, good. Okay, I got a question here. What is this? This is a webinar on a subject matter of Discover a Mind of the Trader. So I'm going to be talking about the psychology of trading. Okay, excellent. Abby, I'm glad you can hear me. As long as everybody else can hear me. Thank you, Nicolai. Brilliant. Everybody can hear me. Great. Good. Now, carrying on with the introduction of myself. Like I say, I'm an avid market commentator. I'm very passionate about the markets and have been ever since I was a wee nipper at the age of 18. I blame my first viewing of Wall Street on that. I'm a well-known public speaker. I actually go around the world and I do several industry events, seminars, things like that. I do talk on several of these major things. So let's move on to what tonight is all about. Like I say, this is the second episode of the Discover series for Banc. And tonight's agenda, we are going to be talking about a mind of a trader. Now, one of the topics I'm going to go over, and some people may laugh at this and think, well, this just doesn't make any sense, but it makes perfect sense, is what is the difference between a gambler and a trader? Then I'm going to go over a topic of the 5 stages a want-to-be trader goes through. And I'm going to ask you an honest question. It's a question I want you find people, obviously, to ask yourself what stage you are at. Then I'm going to discuss how to enter a mind of a trader, what sort of approach you need to be able to take and make to make it trading or online trading work for you. Then, of course, I'm going to discuss some of our educational events for the rest of the month and for October. And, of course, then we'll do a question and answer session. So if you have any questions, then please feel free to ask me, or hold it back if you could at the end. What am I talking? I'm talking about the psychology of trading, sir. This is what I'm talking about, which is a very key area which needs to be understood if you want to try and make it in trading. No, this is education, my friend. I'm sharing you with something. Take it or leave it. Interesting question, though, but please feel free to ask me at the end if you like. Okay, so gambling versus trading. Now, if you're involved in a market investments, especially online trading, as we all know, can be extremely risky and dangerous. You must really ask yourself a question. And this is an honest question. You need to ask yourself this. First of all, why you're getting into this field. And the second is, what type of person are you? Are you a gambler or are you a trader? Now, to answer this question honestly, you must understand the difference between the two. And again, you must be absolutely honest with yourself what you fall under, what direction or what thing you fall under. Now, for a gambler, okay, the overall motive for trading is the adrenaline, it's the rush, it's the excitement, it's the thrill of, so to speak, being in the game. Okay, it's the excitement. And let's face it, let's be totally open. When you're trading with all the charts, all the flashing lights, all the little indicators, all the rates flashing at you, all the market alerts, it can be extremely exciting. Okay, so a gambler really goes in for the adrenaline rush of the excitement of it. They are more freestyle with their approach to trading. They make decisions basically on a whim. Okay, by just seeing me going, I'm excited, I'm going to jump in, or I'm going to miss out on something. And they do it for the sake of the fear of missing out, but at the same time, the excitement. Now, the common practices a gambler does, again, if you have an existing trading account with Banc, this is something you need to ask yourself about these actions, okay? Are you trading without the basis of solid information? You know, because if you're trading with the basis of solid information, you're leaving yourself, extremely vulnerable to the random nature of price movements. And let's face it, no one is bigger than this marketplace. This market is huge. So you're just leaving yourself open to, any sort of dangers and things of that nature. They tend to use, more of a sort of 5-minute, 1-minute charts, because let's face it, it's more fast moving than the longer running charts. So of course they get excited and all this jazz. So they get themselves carried away with that. They react to the latest economic releases without beforehand understanding what those economic releases are about, or what the expectations are, or understanding how that could possibly affect the market. They're not looking at it for price flow or any countervailing information. They see something happen, they see something announced, and they jump in again, worrying they're going to miss out on something. Again, for the thrill and for the excitement of it. A trader, on the other hand, they know that trading is actually more of a craft. They know it's active trading is a craft. They take their time to learn, and they use informed knowledge to base their decisions upon. They work hard and they practice. Their trades are not random. They're not just jumping in for the sake of it, or jumping in for the fear of missing out, or jumping in because something's just suddenly come to their attention. No. That trade they're placing is based upon rounded decisions. They've already know their plan. They already know a strategy. And this is important. They follow a very strict action plan that consists of very prudent, very strict money management structure. So they go in a lot more calmer. They take away the excitement. They control themselves. Now, the trader's common practices includes the likes of the following. They trade calendar risk on a reactive basis. They enter and exit the market in a very disciplined manner. They're not reacting on emotion. They go into the market based on other decisions and things they've already decided of beforehand. They tend to use longer time frames, on their charts, because obviously the common theory is that the longer the time frame, the more accurate the potential support and resistance levels. So they look at a longer time frame to try and get an overall picture of something. They carefully calculate their technicals, like the Fibonacci retracement levels. And they only make decisions when multiple time frames confirm their analysis, and their analysis is grounded on a foundation of an understanding of what they know is going on. Having an understanding of what is occurring in the markets on a daily basis and understanding the underlying economic or political story driving the market and creating sentiment. Because like I say, you have to understand. They take the time out to understand what the story is, what the media are talking about, or what the market is focusing upon. They take their time out to listen to this, understand, for example, why consumer price index has an impact on the market. Why does it affect it? Why can it possibly move a currency up or down? They understand if the people are talking about this, if this is headline news, they understand it. Again, this takes hard work and discipline to do this. But this is what a trader does, not what a gambler does. So, which one are you? Ask yourself that. Just be honest with yourself. Are you emotional? Are you going in it for the excitement? Are you going in it for a, what is your purpose of having a trading account? Why do you want a trading account? Why do you want to trade? Do you have a long-term plan? Is it something you're looking to maybe potentially work upon and see if trading is for you? Because let's be open, trading is not for everyone. Are you going into this because, you want to try and see if you can be a trader and make a little bit of additional income? Or are you going in for the big win? You're going to put all your money on black, all your money on red, and hoping you will get, 5,000 times back. Because here's the biggest difference between a gambler and a trader. And it's really simply work and effort. Now, success, like everything in life, does require hard work and effort. It doesn't guarantee it. It doesn't guarantee it at all. But there's an old saying as it goes, failing to plan is straight away means you're planning to fail. Gambling is more to do with blind luck. It's more about, just taking your chances. And if it comes in, it comes in. That shouldn't be how trading should be acted on, And trading is a skill. And for some individuals out there, not all, some individuals out there are good enough to make it into a profession. So again, these are questions you need to ask yourself. Which one are you, and what is your overall goal? What's your game? What you're looking to achieve with this? Are you going in for the excitement? Are you going in for the quick bucks? Or are you looking to build an account over a long time? Build a portfolio. Take the time to understand certain factors which could help you with your trading. Because trading is all about discipline and understanding the importance of information and using and sticking, more importantly, to a plan. As simple as that, sticking to a plan. Now, there are 5 stages that wannabe traders go through. Okay? Go through. A little sip of my drink, my throat's getting dry, excuse me. Lovely. 5 stages wannabe traders go through. Stage 1 is the unconscious incompetence. Stage 2 is conscious incompetence. Stage 3 is the awakening moment. Stage 4 is the conscious competence. And stage 5 is the unconscious competence. Now, I'll go through each of these stages one by one. Most people, or most traders, or wannabe traders, people who want to learn trading and become traders, they get stuck, realistically, at stage 2, the conscious incompetence. Let me go through all these stages so I explain to them what they are. Now, unconscious incompetence are those wannabe traders who open up a trading account and they don't know anything. They don't understand what a pip is. They don't understand what leverage is. They don't understand what is potentially moving the market or what things to look out for. They just do it on a whim, or they do it because, they're excited by it. What happens then is 2 things. They either place a trade and, of course, obviously they lose, or worst of all, they place a trade and that trade, by blind luck, ends up being successful and they end up profiting. And then that's more dangerous because at that point, because of blind luck, they think this is easy. Trading is easy. It's easy to make money doing trading. So then they put more money in and they end up then losing and crashing and burning. Okay. Some people, the path to being a trader stops there and it goes no further than that. Others go on to the next stage, which is conscious incompetence. This is the stage when they start to realize, okay, I need to take the time out to understand a few bits and pieces. I need to understand maybe some technicals, what Bollinger Bands are, for example, or what support and resistance is, what fundamental analysis is, what's the non-farm payroll. And they start doing a little bit of time, reading some books on this, doing some stuff like that. And then at the same time of that, they then start, looking on the online for the secret, computerized program, EAs, expert advisors, which they think is the holy grail, which will help them deliver constant profits and all this, which is, of course, always a load of baloney, it's not real. So they go off searching for this thing, and it's not, and they get themselves lost and confused. And guess what? They continue to carry on losing, even though they're using Bollingers or technicals. They think they understand, but they carry on losing. Some, and very few people, ever get to the next stage. And this is this is huge. This is the awakening moment. This is when you suddenly wake up to the fact that trading isn't all about just reading and understanding technicals and fundamentals. It's about mindset. It's about control. It's about having a plan. And once you have that awakening moment, those who get it then move on to stage 4, which is the conscious competence stage. This stage, they're still very nervous, they're still very emotional, they're still very much attached, but at this stage, they have a plan, they have a strategy, and they keep to it, they follow it, they don't deviate from it. And those who are able to do that are then finally able to move to stage 5, which is the unconscious competence stage. Okay. And at this stage, their plan is so finely tuned, so finely like a perfect operation, that they find themselves just doing it automatically without even thinking about it. Now, the reality is, unfortunately, most people or most traders, wannabe traders, I say, not traders, want to be traders, they get stuck at stage 2, the conscious incompetence. They get stuck here and they cannot get past this stage. And this is a stage most wannabe traders become. Now, again, this is a question you ask yourself. Ask yourself, okay? Be open with yourself. Because, ask yourself this question. Do I stick to a plan? Or do I even have a plan when I'm trading? Do I get emotional over my trading? Do you flood your chart with so many different indicators that it looks like a Jackson Pollock painting? It looks like a work of art done, or maybe even an 8-year-old's got it. And there's so many different flashing bits and pieces on it. Do you flood your chart with many indicators? Do you take responsibility for your losing trades? Or do you blame other people when you lose? Like the platform, or the EA, or the market, or even a broker? Do you take responsibility for your own actions when you're doing it? Do you have a trader's diary? And I'll talk what a trader's diary is in a minute. Do you have one? Have you even started writing one? If you are basically saying yes to or say no, I have no plan. Yes, I get emotional. Yes, I flood my chart with indicators. No, I don't take responsibilities for my losing trades. And no, I do not have a trader's diary. Then the reality is you are stuck at stage 2, which is the conscious incompetence. You can't get past that stage. Now, inside of the mind of a trader, this is what a trader does. This is what he is, or she is, sorry. Okay? First of all, they're detached from their trades. They're not emotionally attached to their trading at all. Getting out of a trade, even winning or losing, doesn't actually matter. It doesn't matter if you've got a losing trade or a winning trade. They know they're not attached to it. They know that losing is part of trading. They're already aware of that. Being detached allows you to be more focused on getting the process right instead of being so emotionally attached to something that you can't let it go, which can often, lead to hope and fear, or the battle of hope and fear, which causes the trade to lose even more. Detachment also allows you to have the sense of calm, and you do not get lost in market noise because of this detachment. Also inside the mind of a trader, discipline. Trading, at the end of the day, takes patience. It takes energy. It takes motivation, which all require discipline. You need discipline to follow the process and to keep your trading system. Without that, if you have no system, you have no strategy, you're not disciplined enough, how are you going to keep to it? You need to know discipline as well, or have discipline to know when a loss is a loss and not make excuses. Trade size. Again, this also goes down to gambling and obviously trading, okay? And your risk management, because traders, their first rule of thumb, the first rule is not to go out and make the big money. Their first rule of thumb is to protect their account balance. protect how much money they have there. They protect their portfolio first. That comes first. The gains and bits and pieces you could possibly make on that comes later. So money management is huge. And money management and their trading strategy goes hand in hand. Professional traders tend to look to trade smaller contracts or lots. They don't take big risks with big trades. They don't. That's not what they do. Their plan is to build a portfolio up over time. Build it up. And more importantly, protect their account balance. Bernard Optit, I can't even say his name. I do apologize, Bernard. I'm terrible at names, so forgive me. He once said, and he's a French hedge fund manager. I'm trying to remember the name of the company he represents now, but he's a very successful hedge fund manager. He once said, you do not need to risk a lot to profit a lot. And trust me, he's made a career out of doing it. Risk aversion. Nah, this is a biggie. Okay, because it's risk aversion. Let's be open. Online trading or any type of investments are extremely risky. Very risky. Okay? So what a trader does, okay, he's aware of this, and he knows that trading does involve fear and anxiety. He's aware that he could lose or she could lose. Professional traders are aware of this, and they look at trends, and they try to identify breakouts or reversals. They also limit their risk by trading small and only looking at adding to winning positions, not losing positions. You know, you don't add to a losing position because you're pouring fuel on the fire. How many times have people traded and you've got a losing position, but you're scared, you can't let it go. Again, that's part of detachment. So you can't let it go. So instead, you put more margin on it to keep it open because you're paranoid the market's going to bounce back. And before you know it, you've got an even bigger loss. So risk aversion. Because guess what? You're going to lose some trades. Trading, there is going to be loss. So you need to accept that. And this is why a part of risk aversion comes into a mind of a trader. This is why they're easy to step away when the market is not telling the right signals or they're feeling uneasy about it. Firing off, they turn their laptop off, close their mobile off, turn their computer off, call it a day and walk away. I'm not getting it today. Today is too choppy. I'm walking away. And they do this because they know, just walk away from it. Now, before I go to up and coming educational events, I mentioned, and I will do a webinar exclusively on this, about one of the ways to get over those 5 stages, get to the awakening moment, which will help you, or it can potentially help you. And that's a trader's diary. And I will do a webinar and I'll show you examples of this, but just to give you a little bit of a heads up of what it is. Okay. A trader's diary is, the idea is you can do it on an Excel sheet or even a bit of paper. And what you have the date, instrument, entry level, stop loss, obviously take profit, and the reason behind the decision to do that trade. And the idea is that you fill in all those boxes, all those categories first before you click trade now. And the reason why we do that is because you take the emotion out of your trading, as you're not quickly just pressing click to enter the market. You're thinking rationally about it. So you're making your decision based on rational decision making instead of the emotional being lost with all the activity of the charts and all the emotion. I will do a special one on that. So, because that's all part of the risk management series. And I've got a new webinar coming called Discover Risk Management, which we'll go over as well. Up and coming educational events. The last one for the month, which is next week, which is going to be a bit more technical based. Today I've done psychology, and I do like to shake it up. I like to do sometimes a bit of fundamentals, then I do a bit more psychology, then I do risk management, then I'll do some technicals again, then I'll maybe do some case studies on particular instruments and things of this nature. But this one, the next one is going to be more technical based, and I'm going to discuss how to discover support and resistance, how to use resistance and support levels, etc. to to whatever you need or whatever you like. So we'll be discussing that. That's on the 27th. Then after the 27th, I'll be releasing an October schedule for the rest of the month. I'll give you a little bit of heads up what some of the topics here. I've written it down to get it done. So give me a second. Let me pull up my schedule. Here it is. Oops. Let's have a look. Okay, so the schedule for October so far is as planned. I'll let you know if it changes. Obviously, it's going to be released just after the 27th, before October comes. Really? Typical. Taking a while to work. Give me a second. Okay, I can't remember. Anyway, it's going to be obviously psychology. I'm going to do Elliott waves actually as well. I'm writing something on Elliott waves, Elliott wave theory. I'm also going to be discussing, again, more technical analysis, moving averages. One seminar. I'm going to be doing a case study on the euro and the British pound as well. So yeah, anyway, the schedule will be released for that. So on that note, is there any questions from you fine people you'll like to ask me about what I've just covered about the mindset of a trader? Any questions at all? And Tan, no, this is for education. You take with it to your question, you take from it whatever you like. Is there any questions at all from anybody? Anybody like to ask me anything? Any questions at all? Don't be shy. Give it a try. Excellent. Thank you, Christoph. You liked it. You found it useful, though, yes? Ah, Nicola, not for the moment. Good. Okay, glad. Thank you. Okay, to be totally, that's nice. That's a question there, Apam. How much is the minimum amount to start to trade? Look, I'm education. Okay, so I'm here to do the education and share information. If you have an account with Wise Bank, then I would suggest discuss it with your account manager, what fits in your parameters, and what you're looking for. It's not, I can't answer questions of that nature because I'm education, I'm not an account manager, but please discuss that with the educational manager. They will discuss that with you. But like I say, it's the amount, obviously, you need to think very carefully what your goals are and what you're doing this for. Any other questions at all? Okay, actually, that's an interesting question. There's Christopher there. He's asked me a little bit about what I mentioned, hope and fear, and what that is. Okay, I tell you, I do presentations on one of the webinars on hope and fear, because again, it's part of the psychology of it. It's part of risk management. For the sake to ask you a question, Christopher, I will say to you that hope and fear, everybody goes through when they're trading. And it's the most difficult thing to overcome. Okay, now picture this. Okay, you have a trade in the market and it's in the green, so you're making profits, so you're being successful. The feeling you get straight away is one of excitement and happiness because you're making profit. Then what sneaks into it, okay, is that little bit of fear that any minute now the market's going to turn against you, okay, and you're going to start losing that trade. So what you do instead of being happy and keeping the potential profit to rise, what you do instead is you snatch at that profit, closing the trade very quickly, taking a small profit. That's fear. The other side of the story, you have a losing trade in the market, okay? It's in the red, so you're losing. But this time you're not feeling fearful. You're feeling hopeful. You're going to hope that trade's going to come back for you. It's going to start to rise back and go back in your favor. So what then happens is you then keep it open. The market doesn't go against you, okay? Doesn't go against, carries on going against you. So that loss gets bigger and bigger and bigger. Before you know it, you're closed out of that position, or you've had to take a bigger hit, okay? Everybody does this. You start out, everybody goes through this battle, okay? Because then what you will then see in your trading account, you'll see lots of little profits, but then lots of big losses as well. Because the secret to this, really, reality is if you got to try and swap those two motions around. So when you're in a winning trade, you got to hope that it will carry on going up. If you're in a losing trade, you got to be more scared. You got to be fearful that you're going to get into a big loss. And that's one of the most difficult things to do. Like I said, I mentioned to you earlier on, the trader's diary is a good technique to try and counter that. Okay, Abby Rose, nice question. Traders take risks, so will there be a winner or loser on this? Well, traders always take risks, okay, because they know at the end of the day, losing is a part of trading, okay? No one is going to have like 100% successful trades. They're not. In fact, most successful traders, if you look at their account, 50% are winning and 50% are losing trades. The difference is what makes a successful trader to a losing trade, unsuccessful trader, is a successful trader knows this. So what he does instead, or she does instead, for one, she's a bit more they're a bit more disciplined, but they have strict risk management rules, so that know that their losing trades at the end of the day will be the total profit of their losing trades at the end of the day will be less than their profitable trades. It's not the numbers of trades. It doesn't make a difference. Like I can have 80 successful trades and 20 unsuccessful trades, which will make me a successful trader. No. It's not the difference in the number of losing or winning trades. It's the risk management which goes in part of that. And again, that goes down to your risk reward ratio. Like if you're setting your take profit and stop loss to like 2 to 1 or 3 to 1, that's what it depends upon. But good question, Abby. Very good question. Any other questions at all? Okay, let me ask a question, 2 questions out to you, fine people. First of all, did you find, I've already said Christoph has, Nicola, thank you very much for your kind words. Did everybody else find it at least interesting and useful? Or did you enjoy it? Or are you sick of my voice by now? Okay. Thank you very much, Christoph. I appreciate that. Thank you. Alex, thank you very much. Glad you enjoyed it. I'm learning. Okay, Abby, good. Well, everybody's learning, Abby, so you need to take your time, like I say. Yes, very useful. Well, thank you, Nicolai. I appreciate that. Thank you, sir. Yes. Well, thank you. Thank you, Lynn. I'm glad you enjoyed it. How long is this webinar, champ? Well, like I say, as soon as everybody's, as long as everybody got it. Looking forward to more. Thank you, Paul. Thank you for your kind words, man. Appreciate that. Good, man. All right, another question now, because look, to be continued. Oh, yes, it definitely is to be continued, without a doubt. Now, one other question I have, okay, for anybody out there, don't forget, I put these series together. This is exactly what I was going to ask, okay? Is there any subject that you would like me to do a webinar on or cover? And Lynn's just said, very good question. Lynn said, do you do a webinar on FIBS, Fibonacci retracement? Answer your question, yes, I will. Yes, I will. Definitely do one for you. If anybody else has got any other subjects or any other questions, okay, or any other subjects they want me to focus upon, please let me know. I'm more than happy to do it. How big is... Again, it depends on your plan, elders. Good question. Okay. Depends on your strategy, your plan, your risk appetite, and obviously the contract sizes you're trading. But it's an interesting question. It's a good question. Again, it depends on your plan and your risk management. Is there any subjects in the future you would like me to cover? Anybody else? Okay, Paul, that's a great one. Okay, that's a good one. Paul's asked for the part fundamentals play in trading webinar would be good. I would definitely do that. Okay. Yes, I would do that for you, definitely. Okay. Actually, because as I might have mentioned previously, I used to do gold a lot, so I'm actually very much into fundamentals. Because back in the day when I was doing gold, it was more fundamentally driven. But yes, I would definitely do fundamentals. And it's one actually I enjoy doing because I know a lot about that. Okay. Okay, well, okay. Thank you, Martin. Equity management. Okay, good one. I mean, software. What's your take on auto traders? Expert advisors, Christoph is asked. The software involved. Okay, look. Okay, I'm here to sort of share my theories, my experience, and my understanding of it. Okay, this is what I'm here to share. Okay, I can't give advice. I'm here to give you some information and my experience, my passion, with the idea that obviously you take on board, you learn a bit from it, and then you find your own way. In my personal opinion, when it comes, again, it's my personal opinion only, so please don't take it as advice. But when it comes to sort of expert advisors, black box solutions, the ones which do work, they are all, obviously clearly it works, algorithms do work. That's why the banks use them a lot. Okay, the banks use them. But those you see online, you know, being bought for like £25 or 500, that to me doesn't make any sense, because the reason why I say that, again, it's just my opinion. If I was clever enough, and I'm not, if I was clever enough to invent a computer program which would guarantee to make money, do you know the last thing I would do? The last thing I'd do, I would sell it. I keep it myself, you know. So I'm very skeptical. If I'm totally open and honest, I'm very skeptical on expert advisors. Okay, brilliant. Tam, good question. What is the worst scenario for any investor? Okay, well, the worst scenario is a good question. As I've already mentioned, trading and online trading is extremely risky and very dangerous. Okay, if you don't know, you know, what you're doing, and you have proper money management or proper education, understanding of it. So yeah, the worst case scenario, the worst scenario, obviously, is the trader could potentially lose his money or her money. If you put what you put in your trading account, if you don't go in a disciplined fashion or a programmed or planned fashion, yes, you will indeed possibly lose your whole account balance. That is the worst scenario. So this is why I'm one of the old school individuals who always say, if you're starting off and you're learning, you know, only invest maximum amount you can afford to lose. Do not go over that, because the chances are when you're learning, you will lose that. I'm not gonna, you know, I'm not gonna sugarcoat it for anyone. That is the reality. When you're learning, you got to be, you know, you got to understand what you're getting involved in, and there is a great deal of risk, like with any investments. How do you trade and not sit in front of your computer 24/7? Good question. This is Margaret. Again, it's all part of having a plan. Okay. I'm a big fan of, obviously, if you're doing limit orders, okay, limit orders will obviously activate into the market when, you know, when a certain rate is hit. So you can program that in front of the computer on your, sort of on the platform, and that automatically will activate if that trading condition is met and is captured. The other thing to do, if you don't want to, you know, sit in front of the computer 24/7, is have an idea already of a strategy. So if you have an open trade in the market, Make sure you have a stop loss in place, part of your risk management. Make sure you have a take profit in place, because then you know either way, whatever scenario it is, your trade is taken care of. It's not going to rely on you to be there to press, close or open, So that's how you not sit in front of a computer 24/7. Make sure your plan is limit orders, take profits, and stop losses all being used. What I will say though, even though you're not in the market 24/7, again, it's a good idea to update yourself what is happening in the news, in the fundamentals, and in the media, what is occurring, so that like I say, so you know what's happening, what the story is. But again, you got to be passionate about it. So you've got to be really wanting to, read up on this and understand this and follow this. So that's how. But so answer your question: plan, strategy, limit order, take profit, stop loss. That's how you can get around that. Again, it depends. Okay, actually, it depends on obviously your account balance, your attitude to risk, your contract sizes, that sort of thing. That's what, again, it depends on what you're looking to achieve and what your plan is. Yeah, Christoph, no, absolutely. Yeah, except that, again, I'm old school. I'm not a computer whiz IT person. So yeah, I'm skeptical on these expert advisors. It doesn't make, because if I had this amazing black box type thing, I wouldn't tell anybody about it. I'll be sitting on my yacht just using it to make me billions. I wouldn't be trying to sell it for like $1,000 or €1,000 online. So yeah, I'm with you there, my friend. I'm very skeptical about that sort of thing. Okie dokie. Look, Guy, ladies and gentlemen, if there's no other questions, I have to say all of you have been absolutely fantastic tonight. And I'm so pleased you got a chance to spend some time with me, and I'm glad you found it useful. Can I give out a shout out to Abby, Rose, Margaret, Tan, Nicolay, Christoffel, I hope I'm saying that correctly, sir. Arpam, Lynn, Paul, Aldis, Martin, who else? All of that, all these individuals, thank you so much. In particular, you've been great. And I think it's been an absolute pleasure. All those individuals I've just mentioned, thank you so much for asking really good questions. I love the interaction. I love when people ask me questions at the end, because otherwise I feel I'm talking to myself. So it's great. I thank that. Ask your question, Tam. Yes, if you registered, the webinar is always recorded in the video. So yes, you may have that. You can watch it whenever you wish and take from it whatever you have. But anyway, big shout out to every single one of you, especially to the names I've just mentioned. Thank you for your questions and thank you for your interaction. Can I just say, thank you, Nicolay. You're brilliant, mate. Thank you. I really appreciate that. Can I just say, wherever you are around the world, can I wish you either a good morning, good afternoon, or even a good evening, or even a good night, depending where you are around the world. Till next week, which is the 27th, and more to follow, can I say to every single one of you, have a fantastic day, and all of you, trade safe.